Good afternoon, everybody. I'm just going to go ahead and get started. We'll hopefully have a few more people coming on in, but I appreciate the attendance so far. This is exciting news for sure, and we've got a lot going on as it relates to PPP. I'll introduce myself real quick and then allow the other panelists to do the same. I'm Jonathan Krafchick. I'm a partner here in our Raleigh office and able to have been fortunate enough to be working with Chris and Deb and John on PPP for the last few months, as I'm sure many of you have as well. And I'll be moderating the panel today and asking a series of questions that we've come up with as it relates to the PPP Flexibility Act that came out recently. If you have any other questions as the panel continues, please just put them in the question pod. I'm seeing a few come in right now, which is basically, when will this start? Or is there any, is the audio on? And it is, but in any case, if you're having some technical difficulties, we'll try and have people moderate the Q&A for that as well. But without further ado, I'm gonna go ahead and open it up to John Carpenter to introduce himself, and then we'll have Deb Walker introduce herself and close out with Chris before we jump right in to the panel itself. So John, would you like to give yourself a quick introduction?
It will be quick, yes. John Carpenter, and I've been heading up our PPP task force since late March, and I'll just note that in addition to talking about the new terms that came about with the Flexibility Act, for those of you who like to stay glued to the Treasury website, you know that early this morning they released yet another interim final rule. And so hot off the press, yes, we will be talking about changes or clarifications that came out through that IFR just this morning. Deb?
Deb, you might be on mute if you're still connected. Let's go ahead and move to Chris and see if Deb can get her her audio figured out. But Chris, you want to give a quick intro?
Sure. Chris Truitt. I'm a partner in the Charlotte office. I've been involved with PPP since the inception, working with John. And in my spare time these days, I'm a transaction tax partner and head up our tax private equity services group.
Very good. All right, Deb, did we figure it out?
I think we might have figured it out. Does this work?
It does, yes.
Perfect. So I'm Deb Walker. I've been working with the Center of Excellence dealing with PPL loans since they were originated way back in March, and are now focused on forgiveness. I spend most of my time doing compensation and benefits and employment taxes, which is why it was kind of a natural for me to get involved with this.
Very good. And we have been knee deep, waist deep, maybe in over our heads at times in PPP, as I know many of you have as well. And I know you got a lot of questions as we're closing out many of those initial forgiveness windows. So we're just going to dive right in. I see a lot of questions coming in right now about downloading slides. I will say the slides are really just the questions. There's not a ton to download, but we will give you a site at the end to go for more COVID related or CARES Act related information. And then one other person, should I be able to see you all? I'm sorry to ask. We've gone the no cameras option today, but hopefully we'll be able to see each other sometime soon. All right, let's go right for it. This one is for John. So John, can you tell us just quickly, with the PPP Flexibility Act, set the stage, what are some of the bigger changes that came through with the Flexibility Act?
Sure, the three big changes, not going to rank them in order of importance, but arguably the biggest change and the one that affords borrowers the most flexibility is the fact that the forgiveness period has been lengthened to 24 weeks. With the initial program, it was an 8-week forgiveness period. Borrowers can now pick 24 weeks. Literally until this morning's interim final rule, it looked clear to us that borrowers had to pick either 8 or 24, but not anything in between. Later, we'll talk about how we think that has now changed, that borrowers can apply for forgiveness in less than 24 weeks, but probably with some caveats. So that was a really big change, and for a lot of companies, especially I'd say in the hospitality sectors, that were just so devastated by COVID and shutting down, and in many cases had no chance at all of getting to 100% forgiveness in 8 weeks. That's a really big change to be able to extend that forgiveness period for up to 24 weeks. Second big change, I'd say, was the fact that the minimum percentage of forgiveness that has to be spent on payroll costs, which was 75%, has now been lowered to 60%. And just a reminder, that is still a minimum percentage for forgiveness. If you don't hit 60%, that does not mean that you get zero forgiveness. And the regulations even walk through some examples. But if you want 100% forgiveness, then at least 60% of your forgiveness amount has to be spent on what are defined as payroll costs. And a reminder, that's really essentially wages plus employer contribution to health insurance programs and retirement programs. And then probably the third change, perhaps not as programmatically big as these first two, is that if you thought having one forgiveness application was enough fun, now there are two. And much like in the world of tax returns, where you can fill out a 1040 or you can fill out a 1040 EZ, well, now in the land of PPP, you can fill out Form 3508 or you can fill out 3508 EZ. I'm not an easy tax filer, but I think that easy tax return is really easy. This 3508, I'm going to say, is not quite as easy as the 1040. It eliminates a little work. I'm not going to kid anybody. I don't think it eliminates a lot of work. So those are, Jonathan, those are really the three big things that came about through the Flex Act.
Very good. And we're going to dive into a few of those much deeper detail and some of these that maybe smaller, maybe niche changes here. Let's give you a breather and move toward Chris. So Chris Truitt, I know there's maybe some change between 8 and 24, but we'll just stick to 24 for right now. How does the 24-week forgiveness period work, and as it's related or as it's compared to the 8-week forgiveness period?
So the 24-week, obviously, the big difference is you've got a much greater amount of cost that you get to consider, 3 times the amount. So the big savings there is for people making over $100,000, as we all remember from the 8-week period, we're limited to $15,385. You now get to basically take that times 3. So for your highly comp folks, you're getting a much greater number during that 24-week period. I think the big thing to consider when we're looking at the 24-week forgiveness period is that you have to look at your FTEs during that 24-week period. So just like the 8-week, you have to look at your average FTEs during that 24-week period, and you'll have to calculate when you get to the end of that 24-week period what your FTE equivalents, what your FTEs were compared to your base period, and you'll have a potential reduction if you haven't maintained your FTEs during that you had during the base period. There's also an option now, as John mentioned, that if you don't want to use the 8 weeks and you're using the 24-week period, but you get out to, let's say, 10, 12 weeks, and you look at the numbers and you realize that you have exceeded the cost that you need to generate full forgiveness of the loan, you can use that 10, 12, 9, 10, 12, whatever week period that is. You can use the cost during that period to determine your forgiveness. Now, the interim guidance does say that to the extent you would have a reduction for people whose pay you have cut more than 25%, you have to extrapolate that out and apply that for the entire 24-week period, even though maybe you're only using 12 weeks. So you have to take a full reduction for that 25%. What the interim guidance does not address is how FTEs are handled during that interim period. So if you're using 12 weeks and your FTEs are still at 1, so that you wouldn't have a reduction, and then you have a fall off from 12 to 24, let's say you have layoffs, and you go well below your FTE base period, they do not say whether or not you have to consider the FTEs in that 12 to 24 week period in determining your reduction of your forgiveness amount. So that's still some unclear guidance in the rules. One thing to note is if you are using a shorter period than the 24 week period, you do have to wait until you actually have a 941 complete for the quarter that includes the forgiveness period, because that is going to be a required attachment to the loan forgiveness application.
Which
So,
certainly,
Chris,
or go ahead, Deb.
well, Chris, one of the questions that's come through is, do you need to get a lender approval to choose the number of weeks?
And I just don't think we know the answer to that yet. I don't think, given that it was only clear this morning that you could use something other than 8 or 24 weeks. I don't think the lenders have any idea yet how they're going to react to that interim period.
And I'll just say, I think based on what we've read, I believe that it's really at the borrower's choosing. And when you fill out that forgiveness application, there's a place in there to list your forgiveness period. And there's not just a few choices. You literally just pick the dates. And so to the extent you're complying with forgiveness periods as defined, I think you just fill it in on the application, and that's that.
I think that's true. I think the lender isn't really going to control it. And I have a number of clients who've said to me, well, there's so much flexibility here. I'm going to wait a few weeks and I'm going to look at 8 weeks, and then I'm going to look a little later, and, I'll file my loan application when I've got enough expenses. And remember that if you're a June 30th year end, or for any year end, the expenses that you use for forgiveness are non-deductible on your tax return. So with this longer 24-week period, you may want to use expenses that aren't going to end up depending on if you have a fiscal year, you may want to move expenses from one fiscal year to the other and preserve a deduction.
Well,
that happens with retirement plan contribution also.
Yeah, that's great. In terms of, should you do 8 or 24? That's actually our next question. And this kind of sticks with Chris. This has been a pet project topic of his that I think everyone's a little bit curious and passionate about, is which one should I choose, or should there be some variation in between? Chris, I don't know if you have any indicators of any companies that this is a characteristic that would lead you to 8 weeks. This is a characteristic of a company that would lead you to 24.
Yeah, I think the big issue is going to be if you're going to experience some significant layoffs after the 8 weeks, like you were employing people that maybe you wouldn't otherwise have employed to maintain your full-time equivalent that was required to get forgiveness, and you're ending your 8-week period, and you're looking at your business and you realize you need to make some pretty difficult decisions to lay off a significant amount of your workforce because the business just isn't there, then I think you're going to be more likely to look at using 8 weeks. Because depending upon how dramatic those layoffs are going to be, your full-time equivalency percentage could drop to where even when you're using 24 weeks, in some scenarios, you could wind up having less forgiveness in a 24-week period than you would an 8-week period based on the FTE reductions. So that is the biggest issue I think you have to consider. And so with that in mind, if you're faced with that and you're nearing the end of your 8 weeks, I think it's important to take a look at what triggers you can pull to effectively maximize your forgiveness during the 8-week period. So, are there some can you prepay some insurance? Can you fund some more retirement plan benefits? Or there's some other things that you can do to trigger that. Now, I think the problem with that is if you're in a business where you're going to have mass layoffs, you're probably not sitting there flush with cash to prepay all these expenses during your 8-week period. So I think it just comes down to running some projections to see where you are on 24 weeks versus 8 weeks. But I think the flexibility that we learned about this morning to use some interim period is what's going to be helpful. I had a call with a client earlier today, and we looked at 8 weeks, and unfortunately their business has changed. They're going to have some layoffs in the next couple of weeks. And they're about 50,000 to 100,000 short of getting full forgiveness on their loan during the 8-week period, despite having prepaid everything they reasonably feel they can prepay. So we're just going to wait and see. And you don't have to make that decision to use 8 weeks right at the end of 8 weeks. You don't have to. You have flexibility now. So you would just take a look at it after 9 weeks. What were my expenses after 9 weeks, and how does that FTE change impact my numbers? So I think it's a week by week basis when you're in that situation where it's a close call to the 8 week. If you're not getting full forgiveness, to look on a week by week basis until you get to that forgiveness period, and that'll hopefully minimize the impact of the FTE reductions. Again, we don't have guidance on that, but I think it's logical to think that for whatever period you're choosing for the FTEs, you would look at the FTEs during that period. As I say that, that's not what they did for the 25% reduction in wages. So I think it's just still an open question, right? And I think my example was extreme. I think in probably most cases, if you use 24 weeks, unless you have the most extreme case of layoffs, you're probably going to be better off with the 24 weeks than the 8 weeks. But you just have to run the numbers to make sure you're there.
That's one thing I would point out is when we just had 8 weeks, we talked a lot about maybe even paying bonuses that you wouldn't otherwise pay in order to get wages at a high enough level, in order to get expenses at a high enough level. And everybody's thought was, well, it's just forgiven by the government anyway, so better to give it to your employees. With the 24 weeks, that has changed completely. Now there's no reason. You can still, of course, prepay expenses you're otherwise going to pay, but I'm not sure I would pay bonuses that I wouldn't otherwise pay, because you can just wait for the 24 weeks and incur the expenses. Gives a lot more flexibility.
Well, let's keep moving on. There are a lot of questions coming in. I want to kind of get through our banked questions so we can maybe have a time to pick a few and see what themes are coming out. And Deb, don't rest. Your question's next. The other big change that John mentioned at the beginning was the 75% to the 60%. What impact does that have in difference from the 8 versus 24 weeks?
Right. So originally in the 8 weeks, you had to spend 75% of your loan amount on wages. And that reflected the fact that when the statute was first passed, everybody was focused on using these amounts to keep people paid on the payroll and not collecting unemployment. As we get through 2 months later into the Flexibility Act, the focus changes more to, we're going to help businesses sustain themselves. And in fact, with the 24 weeks, but only 60% of your total forgiveness amount has to be for wages. So it's going to be a much easier, the 60% applies whether you use an 8 weeks or 24 weeks. And it's you can of course ask for more than 75% of your loan amount for ask for forgiveness using wages for more than 60%, but you don't have to go all the way up to 75 now. A lot more flexibility, and I think a recognition of the fact that this is really helping businesses to stay afloat for a longer period of time, even if they can't. And we'll talk a few things about how you can exempt yourself from the full-time equivalent calculations, even if they can't attract their workers back, and therefore their wages are reduced.
Well, let's move toward an example that that we were discussing yesterday as it relates to some of the topics we've already brought up. And Deb, you want to walk us through this $1 million loan example?
Okay, so we have, in this example, this is something that bothered all of us when the first loan application came out. And everybody said to themselves, this can't be right. And yet the second loan application came out and it's still the same result. And what I'm talking about is that the FTE reduction, so you're going to take a fraction, which is your FTE over your covered period divided by the FTE over a base period. And in this example, we're saying, okay, our FTE reduction is 90% during an 8-week period. Well, things didn't get very much better between the 8 and the 24 weeks in this example. And now we have an FTE reduction of 60%. Remember, we had $1 million loan. If I use the 8 weeks, then I take the eligible costs, we're assuming $1,000 in 8 weeks, and 3 times as long a period, I've lost workers, obviously, because my FTE reduction's gone down. Now, in a 24-week period, I have $2 million of costs. Well, the 60% reduction or the 90% reduction goes to the eligible cost. It's not capped at the loan amount. So in the 8 weeks here, if I used an 8-week period, I would have $900,000 would be the forgiveness amount because my eligible costs were $1 million. But by waiting for the 24 weeks, I have a $2 million of eligible costs, of which, even though I have a bigger full-time equivalent reduction, I still end up with a forgiveness amount of $1 million because the 60% gives me $1.2 million, which is more than the loan amount. So that's one of the reasons, even though it seems easy, well, 8 or 16, there's lots of calculations that you need to think about. And the biggest thing to me is I don't think I would incur any expenses that I wouldn't otherwise incur. And I'm also going to pay attention to the loss of the tax deduction for these expenses, and especially for retirement plan contributions, because they might be 2019 contributions.
Good point. All right, let's move back to John. And John, you mentioned at the beginning that the EZ form wasn't necessarily easy, but it was maybe easier than the long form. What's the reason for having two? And can you talk a little bit about who can use the EZ form versus who's not allowed to use it?
Sure. Well, it would seem as if there was at least some desire on the part of SBA to make the process a little bit easier for some borrowers. And so first, let's touch on who gets to use the EZ form. Not everyone gets to choose. There are some restrictions around that. And so there's basically on the form, they've outlined, you can use the EZ form if you can check a box and make a certification as to one of 3 conditions. Condition 1, probably the easiest one, especially for sole proprietors, independent contractors, your single person entities. So if you are a self-employed person, independent contractor, or sole proprietor who had no employees at the time of your PPP original application, and you did not include any employee salaries in determining your loan amount, then you can use EZ. And indeed, you probably should. It's really easy. If you have employees, if you are a larger company, an LLC, an S Corp, or a C Corp, then you can still use EZ, but you have to meet one of 2 conditions. Condition 1 would be if you did not reduce annual salaries or hourly wages for any employees making $100,000 or less. If you did not reduce any salaries or hourly wage rates by more than 25% during your forgiveness period, that's condition 1A. And 1B, if you did not reduce the number of employees or the average paid hours of employees between January 1 of 20 and the end of your forgiveness period. Now, that's longer than 8 or 24 weeks. So I'll say it again, if you did not reduce the number of employees or the average paid hours of employees from January 1 through the end of your forgiveness period, then, and there are some exceptions, you can ignore individuals who could not be rehired because they didn't want to come back to work. You couldn't find similarly qualified employees, or they asked for a reduction in hours. So if you can meet those conditions, and I know that's a lot of conditions in a quick sentence, then you can use EZ. And then the third category of businesses who can use EZ are the ones who meet the same 2A test, namely they did not reduce annual salaries or hourly wages by more than 25% during the forgiveness period. And then their second condition is if they were unable to return to the same level of business activity as before February 15th, due to compliance with requirements or guidance issued by either HHS, CDC, or OSHA, CDC probably being the most important one, related to the maintenance of standards or sanitation, social distancing, or any other work or customer safety requirement related to COVID-19. So this could potentially cover an awful lot of businesses. You know, one would think that practically every restaurant in America would be impacted by this, probably every hotel, a great many, if not every retail establishment. You do have to document what sort of requirements you were complying with that required you to maintain different sanitation standards, social distancing standards, or other work or customer safety requirements. You have to have that documentation in your file. It does not have to go to the lender, but you do have to have it in your file. And it would seem that simply saying, well, business is down, revenues are down, but they're unrelated to health or safety requirements, that's not going to get you the avenue toward an easy application. And so the easy application is a little bit easier. We have seen in that form, though, and it is important to point out that although really what you get out, I mean, what borrowers get out of reporting is having to report some FTE numbers and a few other things. However, that doesn't mean that you can totally ignore them, because unless you're going to meet a safe harbor, one of the several safe harbors available, then if you're going to comply with all the requirements, you still have to calculate those FTEs. You have to hold those calculations in your records and be ready to produce them anytime in the 6 years after forgiveness if you're audited by SBA. So in that respect, I think that's why we say that the EZ application is probably not quite as easy as they might like us to think it is.
It was better than calling it the hard and the harder application, I guess.
That's true. True.
There's been a lot of questions coming through the Q&A about sole proprietors, and a lot of times the focus gets on the more complex types of situations of the larger companies, but can we talk a little bit about sole proprietors for a second, Chris, and any restrictions or any unique circumstances that sole proprietors need to keep in mind? And you might be on mute.
Of course I was. Sorry about that.
It's no problem.
So I'll split it into two discussions, really. We have owners of companies, meaning C Corp owners, S Corp owners, and partners in a partnership or members of an LLC, and then true Schedule C type sole proprietors. We'll start with the sole proprietors. I think they're a little easier. So in the simplest example, a sole proprietor is going to use 2019 Schedule C, assuming that person does not have any employees, and all they're using when they applied for the loan was simply their Schedule C SE income. If they're using the 8-week period, the most they're going to be able to use is 15.385% of their 2019 Schedule C, assuming they made over $100,000 on their Schedule C. That means they're going to be capped at $15,385. And if they're using the 24-week period, it's not 3 times that. It's only going to be 20.833% or $20,833 for the 24-week period. And the reason for that is if you looked at what say a simple Schedule C sole proprietor would have applied on the basis of it, have been their Schedule C income for 19 divided by 12 times 2.5, which is exactly $20,833 for a Schedule C of more than $100,000, $100,000 or more. So they're not letting you take owner compensation and skew it to drive more of the forgiveness when you go to the 24-week period than if you were using the 8-week period. They're capping it at the amount that you would have been able to consider in your borrowing base, if you will. So I think like I said, the reason for that is not to allow the owners to lay off all the non-owners and continue to pay themselves for 24 weeks and get more than $20,833, that they could get up to the 46,000 roughly. So that is the case with the sole proprietor. And of course, if you had employees on your Schedule C, you would still be capped at the $20,833 if you're using the 24-week period, assuming your SE income was $100,000 or more for the prior year. And then you look at the wages paid to your employees during the 8 or 24-week period or the intermittent period, if you choose to use a shorter period than the 24 weeks. So switching kind of to the guidance this morning was pretty clarifying in that even C Corp owners are now subjected, because they had said owners period before, so they've clarified it to include C Corp owners in that definition. So if you own part of a C Corp, however small, your compensation you can consider for that owner is going to be $20,833, regardless of whether you're using 8 or 20. Well, if you're using 8, it's $15,385, assuming you made at least that much in the prior year, and that you're making at least that much during the 8 or 24 week period. So it's C Corp owner is going to be capped at 2019 cash compensation plus his retirement and health insurance. You actually get the retirement and health insurance for the C Corp owners. For S Corp owners, same things apply, except they don't get to pick up any of the health insurance. Cash compensation is limited to the $15,385 if you're using 8 weeks, and $20,833 if you're using 24 weeks. Of course, if you're paying yourself less than that, you use a lesser amount. And then partners in a partnership, so members in a LLC, they're going to use their 2019 SE income reduced by 179 deduction and unreimbursed partnership expenses that they may have deducted on their personal return. And you multiply that by 0.9235. And the reason for that is only 92.35% of your income is subject to actual self-employment tax. And so you take that number and it's going to be capped at the $15,385 or the $20,833. And it'll be, of course, based on a lesser amount if you made less than $100,000 in the prior year. That's a lot of stuff I just threw out there. So Deb, John, any clarifying comments you guys want to make as I rambled on for probably too long about that topic?
No, I think the only thing I would just emphasize, and to us this now looks even clearer than ever, is that because regardless of what type of owner employee you are, because it is the lesser of these dollar amounts you cited, or a fractional, proportionate percentage of your 2019 comp, for people who had a K, for whatever reason, if their 2019 K1 was exceptionally low, it could just be the difference between book versus tax differences if you're a cash basis tax filer. If you're a sole proprietor and your business was started in 2019 and you did not even get a full year of income, then you're really out of luck. Because you are going to get restricted to either 8/52 or 2.5/12 of whatever that 2019 income showed on your K1, your Schedule C, or your wage rate. So there are some possibilities that owner employees really get restricted on what's going to be eligible in that respect.
And I think the only saving, well, at least now we know that C Corp and S Corp owners are capped, and we know that the cap applies to, doesn't apply to retirement benefits for those guys, or health insurance effectively, because the S Corp owners have the health insurance included on their W-2. But because we have the 24-week period, it might not be as harsh as what we had expected before.
I'd say the one difference in the S and the C with the health insurance is the employer portion of the health insurance for a C Corp owner, does get counted. And in most cases, an S Corp owner is already going to be over the $100,000. So even though the health insurance is in the number, you're still going to be capped at the $15,385 or the $20,833. Whereas a C Corp owner, you get a little bit more than that because of the employer paid health insurance. So that's just one slight nuance between those two.
Right.
All right, well, let's move on to you, Deb. And speaking of, John brought up kind of, you weren't in business all of 2019. You may be a little out of luck. As a sole proprietor, but similar theme about seasonal employees. It's summertime. We just got through winter, and the seasonal businesses have been a bit of a hot topic as it relates to PPP. Were there any changes in the Flexibility Act as it relates to seasonal employers?
So this is something that I'm concerned that people aren't paying enough attention to, because there were always provisions for seasonal workers or seasonal employers. And even when you did your loan application, you used 12 months because they didn't issue the regulations on what the rules were you could use for seasonal employers until about a month after the legislation had passed. So what that means is if you're a seasonal employer, a summer season employer, then you may be able to get a bigger loan than what you applied for, because instead of using 12 months of your salary determined on a monthly basis multiplied by 2.5, you use 12 consecutive weeks during the summer period from May 1 through September 15th. And there are provisions that you can go in now and make another application to increase your loan amount. In addition, they've told us that when you calculate your full-time equivalents, if you're not using the EZ form, but if in any event, you get to look at the 12 consecutive weeks and compare that instead of the entire covered period. So that I think it's important for seasonal people to go back and see, one, if they can get a higher loan amount. And unfortunately, of course, the ability to apply for a loan expires at the end of this month, and that hasn't been changed. So there's not much time for you to go back to do that.
Very good. All right. There's been a handful of questions about this, and this is for you, John, about the June 30 safe harbor. Did the Flexibility Act address anything as it relates to changing the June 30 safe harbor?
Well, it did, and a little bit good news and bad news. I mean, overall, it makes clear in the law that wherever that June 30 safe harbor was noted, that's now been replaced with 12/31. So certainly, if you need that 24-week forgiveness period, then this is probably good news. And it also seems clear that not everyone who needs the full 24 weeks has to wait until 12/31, because now it appears that your safe harbor date can come to an end at the end of your forgiveness period or the date your application has been filed. As it relates to FTE reductions, as Chris cited earlier, it still to us seems a little gray around if you feel like you need to make some FTE reductions. It certainly would seem like you need to wait till after your forgiveness period. But what happens between the end of the forgiveness period and 12/31? I mean, to us, common sense would say that you can do whatever you want with your FTEs after the end of your forgiveness period, but I'm not really sure the guidance spells that out as clearly as we would like. And then as we kind of alluded to earlier, but just reinforcing, is that, keep in mind the application forms, whether it's easy or regular, all say that included with your application, you need to include your 941s that overlap with your entire forgiveness period. So as we sit here today, near the end of June, for anyone who's going to extend a forgiveness period, even to July 1 or 2, then you're not going to be able to apply for forgiveness until early October, because you're going to need to include your third quarter 941. In a similar vein, if your forgiveness period lapse over from September into early October or beyond, then by default, you will have to wait until after year end, because you'll have to include a fourth quarter 941.
Interesting. All right, we'll talk about the readiness of banks here in just a second, but let's move to Chris. What should borrowers be doing now? We've heard a lot about what the Flexibility Act changed, some good, some bad. Forgiveness periods, if you're at the 8 weeks, the windows are starting to close down a little bit. What are some things that borrowers should be doing right now?
I really kind of summarize a little bit of what we've talked about. It's really assessing where you are in terms of forgiveness at this point in time. If you're nearing your 8-week period, if you're close, I would consider pulling some triggers that you can to maximize your forgiveness to get to 100% at the end of the 8-week period. Because as we've seen with this guidance that keeps coming out, we think we are playing under one set of rules, and then suddenly we're playing under a different set of rules. So although we think we have good guidance, I think the only thing we really know for sure is there's probably going to be additional guidance, and the rules are going to change on us again. So I'd say if you're close and you can get to forgiveness with your 8-week period, and you've hit your FTEs like you should, or like you were hoping to, I would make sure you're going ahead and doing the things you need to do. Now, as Deb stated, I wouldn't go paying things out of the ordinary that you wouldn't otherwise pay. I'm only talking about prepaying a month or 2 or something like that. I wouldn't go pay bonuses to everybody just because it's the government's money that you're spending, because you can wait that additional time period to still get 100% forgiveness. So assuming you can't get there during the 8 weeks, I think it really comes down to just continuing to accumulate the data on a weekly basis and kind of touching base with where you are each week, and then deciding when you want to pull the trigger. Once you get to 100% forgiveness, I think it's time to probably start thinking about getting the application submitted before the rules change on us again, quite honestly.
Yeah. All right, John, I'm going to come back to you. You had mentioned about how important the June 30 piece is as it relates to the forgiveness period, but some of that's going to be contingent on when we're able to start applying. When will lenders be ready? If they are today, or how soon will they be ready to begin accepting our forgiveness applications?
Well, far be it from me to speak on their behalf, but I think I'm not aware of a single lender anywhere who's ready to take forgiveness applications yet. I mean, heck, think about it. These 2 revised applications only came out about a week ago. Here we had a new interim final rule come out literally this morning, and it does have enough changes in it that lenders need to incorporate those changes into their portals, into their processes of how they're going to process these applications. So I'm hearing a lot of lenders say they expect to be ready to take forgiveness applications sometime in July. I don't think anyone should count on July 1. I think sometime in the latter part of July is more realistic. So just keep in mind that every time there's a change, lenders have to incorporate these changes into the process and the software that they're using to process these applications. And I've heard multiple lenders say that gosh, they're tending to think that perhaps their best course is to wait till at least the end of July, hope that the dust has settled on changes and they don't have to change their process midstream as they're processing forgiveness applications. So I think for borrowers, it's it's worthy to pull information together to be ready to apply. But I would not get your hopes up that you're going to be ready to apply the day after you do your 941 on June 30.
Very good.
And they did say in the guidance that you have till 10 months after the forgiveness period to apply. So it's the long time period that you can apply after the covered period. You can wait 10 months to apply. I don't think anybody will wait that long. But your loan payments don't start until after you've applied and had the forgiveness approved.
Which is a great point, but I will also tell you I think the banks are going to push really hard. They are not interested in processing forgiveness applications all the way until the summer or early 2021. Believe me, they want to get everything. They want to get as much processed by 12/31 of 20 as they possibly can. So I think they'll be strongly encouraging people to get those forgiveness applications in. And if it's a 24-week period, then logically a lot of that's going to happen in, probably in the November, December timeframe.
All right. And it also depends on SBA systems and how solid it's going to be too, beyond just the banks. Let's continue down. This one will just open up to everybody. So we wrote this question yesterday before we had updated guidance, and so I know that was one surprise. Are there any other surprises either in the application forms or in the newly released guidance that maybe we should cover?
I think the biggest surprise that we weren't sure was going to happen was how the full-time equivalents were going to work when we got to the 24-week period. And in Deb's example, where we incurred the $2 million worth of costs and had a 60% FTE equivalents that resulted in $1.2 million maximum forgivable amount with $1 million loan, resulting in full forgiveness. I think we all had we're cautious to think that there may, if you were an FTE of 60%, that they may make you reduce your loan amount to only get $600,000 of forgiveness in the case where you had $1 million loan. But based on the interim guidance that was received and the way the form works that was newly released a couple weeks ago or a week and a half ago, it appears that the example that we went over is the way it works. And we weren't sure if that was going to be the way it was going to work. So that was a pleasant surprise. Some of these other things were not as pleasant with the limitations on owner's comp and capping it at the 20,833 or 20.833%. But I thought that was the one nice clarification that we really weren't sure was gonna stick.
Good. Anybody else have any other surprises that they've found either in the applications or updated guidance?
No real other surprises other than it seems like every day can bring a new surprise.
Well, speaking of, and there was a question that actually just came in about what should we expect next? And the question was in regard to, I can't remember which banking group had sent in a comment letter basically saying, we think all loans under $150,000 should be automatically forgiven. But are there anything else that we think is on the horizon, any common unknowns that we're waiting for, or any predictions that we can make about what we should expect next?
I am certainly not going to make any predictions, but thanks for, I almost think that for borrowers and lenders alike, if we are really finished with changes, I think it'd be great if SBA would just make that announcement saying, that's it. No more changes. We're done. I mean, I'm not expecting that next, but that might actually be a happy next event. I do think, there is some political capital on Capitol Hill around the notion of making all forgiveness expenses tax deductible. That really that's kind of outside the PPP program. And I've not heard that that's got a lot of momentum, but stand by. We have a lot of 2020 left yet to pass, and you got a lot of people on Capitol Hill running for re-election in November, and so in election years, almost anything can happen. So stay tuned. I mean, that deductibility of PPP expenses could certainly come back on the radar again.
Yeah, I thought for sure that would happen. But I think we've had a couple of things passed since that was initially introduced in the Senate, and there's just been no action that I've seen on that bill that was introduced in the Senate. So with every passing day, I'm less optimistic we're gonna see that, but I'm hopeful, but I'm just not optimistic about it. The other thing I would say is it seems clear that with the guidance that we keep getting, that there's a general consensus that they're trying to do everything in their power to make these loans be forgiven. I mean, if you're going to 24 weeks and you're not making haircuts on FTEs kill you, then I think they're making every reasonable effort to have these forgiven, mainly because the banks don't want to deal with having to process and deal with loans outstanding after this is all said and done. So I think there's momentum to be flexible, and the banks want them off their books. So, I mean, that's the other thing that's kind of come through with with the guidance. I was a little surprised they were restrictive as they were on the owner's comp, but I understand the political reasons for it.
John, if you don't mind walking through a little bit of maybe how Cherry Becker can help. I know that as we've seen for the last 50 minutes or so, there's a lot of possible pitfalls and complexities, even as it relates to trying to make things more flexible. But I thought we'd spend a minute or so before we dive into a couple questions on how Cherry Becker might be able to help.
Yeah, absolutely. This is the blatant advertisement section of this webinar. We have been working with literally hundreds of companies on both applications and forgiveness. So in all seriousness, for everyone on the call, if you've not availed yourself of our help, we do want to make it easy for you. We can offer, consulting services on the planning. We've obviously been studying this for a long time. If you just need some consulting help and want to buy a few hours of our time, we've got an option for that. If you've picked up these applications, even if up till now you thought this was all a do-it-yourself task that was pretty easy, and now that you look at the applications, you realize this is a little more daunting than you first thought, then we can certainly help pull together the information and get everything together that you need for the entire application. And I think we've been in seriousness trying to stress to everybody that if your original PPP loan together with loans for any affiliates, if they were over $2 million, then at least according to the Treasury, they're saying you have a 100% chance of being audited. If you're under $2 million, that does not mean you have a 0% chance of being audited. It just means your percentage chance is under 100. But I think it seems pretty clear that SBA will be doing some type of random audits on loans under 2 million. And even though there is an array of information that has to be submitted to lenders, there's other backup information, especially around payroll records, salary records, payroll data going back to your reference periods, all your FTE calcs, all that stuff has to be kept in your records for 6 years. So part of what we're doing is just helping get those calculations, assemble those records, organize them, and hopefully give you an audit package that is as clean as possible.
And if you'd like to go out to cbh.com, you'll see the big picture of whatever we think COVID looks like. You just click on that. There's the direct link right there, and that'll get you right to our engagement letter for the various types of ways that we're able to help. With our last 5 minutes, figured we could just go through a few of these questions. There's been one in particular that's come up a number of times from various people about voluntary attrition, or if people leave not because it was a layoff or a furlough, but because an internship ended or because they found a better job. Does that play into the full-time equivalent calculation any differently, or is it just this, it's just your calculation on FTEs and that's it, regardless of reason?
Now, anyone who leaves, who voluntarily resigns, is not counted against you as an FTE reduction.
That's true. Also, anybody that you fire for cause is not counts against you. And then, of course, the other main rule, which is anybody that you try to rehire that refuses to come back to work, and all of that's documented. You have to have a written offer of employment for them, but none of those people will count against you. There's one question in here.
Then we'll also just say, I mean, one of the other safe harbors around FTEs, which I think to all of us is probably going to be a little bit hard to document, but they do say that if you had to furlough people and then you are unable to find people with similar qualifications to come back, then you do not take an FTE reduction for those positions that you furloughed. That's a little squishy in terms of documentation, but it is out there.
And Deb, were you going to say
one question here? Yeah,
okay.
There's a question here about if you're under the safe, are you under the safe harbor if your employee count has remained unchanged during all the periods in question? And I really think what the questioner meant is can I use the EZ application, which is much simpler. Well, I think it's much simpler, but so yes, that's an exact situation in which you would use the EZ application where your employee count has remained unchanged, assuming you didn't cut anybody's wages or hours, hourly wage or annual salary by more than 25%.
There was another question earlier about, well, one question said, what does FTE stand for in full-time equivalent? But there was another question kind of in the same vein, and I'll just read it here. It says, we operate several schools. Obviously, our number of FTEs decreases considerably during June, July, and August. Are there any allowances in the law that could keep us from losing forgiveness because of a seasonal reduction in workforce, and they do not necessarily qualify as a seasonal employer?
Yeah, so that's interesting because they only went to the summer season. And I think the reason they did that was your base period could be January and February, or it could be the spring. I suppose if it's a school, you probably want to use February through June 30th, because June 30th you might have employment down more than you would in January or February. But unfortunately, there's not a winter season that was provided any relief.
Interesting. There's been some talk, I can't remember who it was that was saying it about, maybe you could apply for more, but can you do a second loan request, or is it one and done? In other words, if you've been funded for a PPP loan, you found out, hey, I could have been applied or approved for more, with our final 7 days to apply here, are we out of luck, or is there room to apply again?
Well, there's room to apply again for the seasonal employer. There's room to apply again if you're a self-employed person and that you didn't properly take amounts into account. So there are limited reasons that you can apply again. I think we'd have to know what the situation was to know whether this person could apply again or not.
Very good. Well, I think we're kind of right at our time. I'm really sorry we couldn't get to all the other questions. We will take them and just export them and take a look to see for themes to inspire future blog posts or future webinars to try and address some of these. But thanks so much to John and Chris and Deb for spending time answering all these questions. And thanks so much to everybody here that logged on. And please don't forget to check us out at cbh.com. And click on that COVID link, and we will certainly be in touch with you if you need it. But with that, that concludes the webinar, and I hope you all have a wonderful rest of the day. Thanks, everybody.
Thanks.